Hi, today we are going to talk about Cathie and ARK ETFs. Cathie is a very famous investor who invests in disruptive innovations. She has very high convictions in some of her very bold calls in the early days, such as Tesla, Teladoc, Zoom, and Shopify, which gained her the reputation of going contrarian and having big bets on highly disruptive technology companies. And her funds, especially in 2020 and 2021, have done a very outstanding job in terms of performance returns. Her flagship ARK Innovation ETF has seen assets grow from tens of billions of dollars to over $40 billion at the peak. And in those 2 years, the share price of the ETF has doubled. She has done very, very well, mainly for two reasons. The first is some of her calls, such as Tesla, has proved to be exactly right. And the second reason is thanks to pandemic, a lot of the companies she invests are the key beneficiaries of the trends moving from physical world to digital, such as Zoom, Teladoc, and Shopify. However, since the second half of 2021, her fund performance have been lagging the overall markets. And we've seen a lot of companies reporting less and weaker than expected earnings and revenues. Companies ranging from Zoom, Teladoc to Shopify have seen their share price decline massively, more than 30-40% in the last 12 months. And especially to date, the flagship innovation ETF has seen a reduction of share price by more than 30%. And here in this video, we're going to cover 5 main areas that we think Cathie needs to look at and fix in order to turn around the performance of her funds. The first problem is timing. So Cathie invests in disruptive innovations and disruptive technologies, which I firmly believe to be one of the key long-term trends, and that is one of the winning strategies in the stock markets for the long term. However, timing is critical. Looking at her past success, one of the biggest contributions to her positive performance so far is Tesla. And that is the stock she is pretty much right on every aspect in terms of volume growth, cost reductions, technology, innovations, and Tesla is the darling in her ETF. So here her approach for Tesla is not only to bet on electric vehicles and battery technology cost reduction, but also at the same time she needs to be right on the timing of it, because with technology at some point you will be able to achieve all those goals, grow volumes, bring down costs, bring down prices so that there is a mass market adoption for the Tesla cars. However, in the early days, you just don't know how long it will take for companies like Tesla, for its technology to reach that critical mass and critical scale. Unfortunately, Tesla works out very well for Cathie, because in the year of 2020, 2021, corresponding accidentally with the pandemic, Tesla has achieved great successes in cost reductions. So there's a massive cost reductions on batteries, so that Tesla is able to produce batteries on massive scales, and also the cost of Tesla is able to decrease very steadily over time, so that there is a mass market appeal cost-wise and price-wise. People are no longer opting for traditional gasoline cars for its cheapness, because Tesla car is now equally competitive on the pricing. But unfortunately, she's not repeating the same success she had with Tesla on some of her other calls, such as Teladoc, Coinbase, Robinhood, and all these companies are large positions in her funds, more than 3-4% of the ETF. And these are great companies. One can argue how great they are and how great they will become. However, looking at her themes she's betting on, from genomics to blockchain technologies to electric vehicles, she may be early, arguably speaking, on some of the areas such as genomics. Some of her holdings are pretty small, and there's just a lack of evidence that things are picking up momentum in a massive scale. So the risk here is that she may well be right on the theme over the long period of time, and arguably speaking, those themes you cannot really argue against. Who doesn't want genomic technologies to become better in the long term, or blockchain technologies? You can't really argue against those. However, what you can pay attention to is, when are we in that timing? When are we in that adoption curve in terms of technologies? And I think looking at some of her bets, she may be early, even though she may well be right over the long period of time on some of these themes. The second problem we think Cathie needs to look at is picking the right companies. It's becoming apparent that lately some of her calls are missing expectations. And in order for growth companies, which is the key area of the markets Cathie invests in, so in order for these companies to work, they have to beat market expectations. So give you an example, if a company is expected to grow at 150%, and they report a growth rate of 80%, which is still pretty high, it's very likely that the share price will go down, because market is forward-looking. So if you begin to miss market expectations, there needs to be a reset of multiples the market pays for certain companies. So such as Palantir, Zoom, Teladoc, these are the companies that start to miss market expectations, or very on the edge, beating market expectations by a very narrow margin. And even Tesla is starting to see supply chain issues. So Elon Musk says, very famously, if you give me as many chips as I want, I can give you as many cars as I could. However, there is a supply chain constraint issues, which was not factored to the right amount, I feel, by the sales analysts and by the market expectations. So even for a company like Tesla, is a very large holding, has done tremendously well, and products and services are tremendously outstanding. But there are signs that even for a company like Tesla, they are starting to miss market expectations. The third issue is more psychological. So every fund manager will talk their own book. So if you're a value investor, you will justify why value is the right strategy. Or if you're a growth investor like Cathie, you will always justify why growth is the right way to go. And when she talks about disruptive technologies, there is nothing wrong about it, and it's almost always right to invest in great companies that will become market leaders in 5-10 years time down the road. However, a fund manager has to be aware of what they don't know at the same time. And looking at some of recent interviews on CNBC or with news reporters, she does not show any signs of admitting that she has been wrong on some of her calls. And a good example is she has sold out completely on Palantir, and that's a stock that she bought only a few months ago. And such behavior tells a negative or a warning sign to the general investor community, because not a single fund manager will always be right, and the ability to know that you may be wrong and admitting that you are wrong on some things is not a bad thing down the road. So that is one area which is quite intangible and hard to grasp. But when you are too invested, when you are too bogged down to your own investment approach, and you end up always trying to justify why you will be right in the future, and that is not a good sign to have. Quite the opposite, I would like to see some self-reflection and self-awareness about the flaws in her investment approach, and it's just the ability or the willingness to admit that you can be wrong on some of her calls, and that is fine as long as you are open to such criticism, or you're open to admit your own mistakes. And the last issue we think Cathie needs to look at is illiquidity. So that is a lot of the companies in her main flagship innovation ETF are quite small. So the fund itself today is about $19 billion of market cap. And that means 5% of the fund is roughly, $800 million, $900 million of investments. However, if you look at some of her investments in Exact Science and Intellia Therapeutics are the two examples. Both companies are, $8-10 billion of market cap. So the ETF itself ends up owning 10%, 12% of the company. And that is a big risk down the road because none of these companies are liquid in terms of trading volume. And if you are a big shareholder of a company, more than 10%, you really, really have to take a long-term view and hope that the company will become 3 times, 5 times, 10 times larger down the road, hence the liquidity will pick up. Otherwise, if you get it wrong, it's very hard for you to exit. And especially for the ETFs Cathie manages, these are daily disclosure. So if you buy and sell something, people know that immediately. And if people know, or if people can see you are starting to sell these small illiquid companies, there will be market panic. So, and this is only on the innovation ETF. As we know, she has also a few other ETFs, and especially she has a specific genomics ETF. So her firm as a whole maybe end up owning 15-20% of some of these smaller companies, which is a concentration and illiquidity risk.